Something is happening right now in the global financial system that most people haven't even begun to notice. And by the time they do, it'll already be too late to position themselves ahead of it. This isn't a theory. This isn't a fringe idea from some corner of the internet. This is a slow-moving avalanche that has been building for decades, and the ground is already starting to shake. Let me ask you something. When was the last time you actually thought about what a dollar is? Not what it buys, not what your paycheck says, but what it actually is. Because here's the uncomfortable truth. The dollar today is not the same dollar your parents saved. It is not the same dollar that once had a vault full of gold standing behind it. It is a promise. And promises, especially ones backed by nothing but confidence, have a breaking point. Right now, quietly, beneath the surface of stock market headlines and inflation reports, the architecture that holds the dollar system together is starting to crack. And when that crack spreads, and history says it will, the metal that has served as real money for over 4,000 years is going to do something extraordinary. Silver is not just going to rise, it is going to explode. If this is the first time you've landed on this channel, welcome to the Bullion horizon. We cover the real forces moving markets, money and metals. Hit the like button right now if you want more content like this. It genuinely helps us reach more people who need to hear what we're about to walk through. And if you haven't subscribed yet, now is the time. We're going to go deep today, because what we're about to cover is not something the mainstream media explains properly. They'll talk about inflation, they'll talk about interest rates, but they almost never connect the dots all the way to what it means for silver. And more importantly, for the ordinary person sitting at home wondering why their savings don't feel like they're going anywhere. Let's start at the beginning. And I mean the real beginning. In 1944, at the end of World War II, representatives from 44 nations gathered in a small hotel in Bretton Woods, New Hampshire. The world was exhausted, economies were shattered, and everyone agreed they needed a new financial order. So they created one. The deal was simple. The US dollar would be the world's reserve currency. Every other currency would be pegged to the dollar, and the dollar itself would be pegged to gold at $35 per ounce. Every dollar in existence was theoretically backed by gold sitting in Fort Knox. That was the anchor. That was the promise. For about 25 years it held. But then something started going wrong. The United States began spending more than it earned. The Vietnam War, the Great Society programs, government spending ballooned, and foreign countries, especially France, started getting suspicious. They started cashing in their dollars for gold exactly as the system allowed, and America's gold reserves started draining. By 1971, President Nixon had seen enough. In a Sunday night television address, he told the world that the United States was closing the gold window. No more exchanging dollars for gold. Just like that, the anchor was cut. The dollar became what economists call a fiat currency, backed by nothing but the faith and credit of the United States government. And the world just went along with it, because what choice did they have? The dollar was everywhere. But here's what most people still don't realize. That moment in 1971 didn't just change monetary policy, it changed the rules of the entire game. It meant that for the first time in modern history, there was no mathematical limit on how many dollars could be created. The printing press was now unchained. And for a while, the consequences were hidden. The dollar maintained its dominance. Oil was priced in dollars. Global trade ran on dollars. U.S. treasuries were seen as the safest asset on Earth. The world kept buying them, and the U.S. kept issuing them. It looked like it worked. But something very quiet was happening underneath all of it. Every dollar printed diluted the value of every dollar already in existence. It was slow, it was subtle, but it was relentless. In 1971, a new car cost around $3,000. A house in a decent neighborhood might run $30,000. A college education was something a summer job could cover. Fast forward to today, and you already know what those same things cost. That gap, that enormous, painful gap between then and now, that is what 50 years of unlimited money printing looks like from the inside. Now pay attention to this part, because it's where the story takes a turn most analysts won't follow you through. The Federal Reserve didn't just print money in small amounts over those decades. They printed in waves. Each financial crisis triggered a bigger response. The dot-com crash in 2000, the housing collapse in 2008, the pandemic in 2020. Each time, the money supply didn't just grow, it accelerated, and the numbers became so large that they genuinely stopped feeling real to ordinary people. After 2020 alone, the United States added more dollars to the money supply than had been created in the entire prior 200-year history of the country. Let that land for a second. 200 years of money creation, doubled in under 2 years. And everyone was told this was necessary. Maybe it was, but necessary doesn't mean consequence-free. And this is where the story changes completely. Because when you print that much currency that fast, something has to absorb the shock. Historically, that something has been hard assets, real things. Things that can't be printed: land, gold, and silver. Silver is different from gold in a way that makes it uniquely powerful in this particular moment in history. Gold is primarily a monetary metal. Central banks hold it. Wealthy institutions buy it. It moves slowly and deliberately. Silver does something gold doesn't. Silver has a double life. It's both a monetary metal and an industrial one. And that second identity is about to matter enormously. Think about the world we're building right now. Electric vehicles, solar panels, semiconductors, advanced medical equipment, missiles, satellites. Every single one of these technologies requires silver. Not because of tradition, not because of sentiment, because of physics. Silver is the best conductor of electricity on Earth, and you cannot substitute it away. You either use it, or the technology doesn't work as well. Period. Global silver demand from industrial applications has been setting records. The solar industry alone has become one of the largest consumers of silver on the planet. Each solar panel uses a small amount of silver paste to conduct electricity efficiently. Multiply that by millions and millions of panels being installed every year around the world, and you start to understand the scale of the demand picture that's building. But here's what makes this genuinely alarming for anyone who hasn't been paying attention. Supply is not keeping up. Silver mining is extraordinarily difficult to scale. New mines take years, sometimes over a decade, to get from discovery to production. And the reality of modern mining is that most silver doesn't come from dedicated silver mines. About 70% of all silver mined in the world comes as a byproduct of mining other metals: copper, zinc, lead. So when those industries slow down, silver supply slows with them. You can't just flip a switch and produce more. The world has been running a silver supply deficit, meaning demand is outpacing what's being mined for multiple years in a row. And those deficits are being covered by drawing down above-ground stockpiles. But stockpiles are not infinite. Now layer on top of that the monetary story we just walked through. The dollar is under pressure. Faith in the US government's ability to manage its debt is starting to erode at the edges. Foreign nations that used to quietly absorb US treasuries are now asking uncomfortable questions. China, Russia, Saudi Arabia, Brazil, India. These countries are having conversations about reducing their dependence on the dollar system. Some of them are already trading with each other in their own currencies. Some are buying gold at a pace that hasn't been seen in decades. Central bank gold purchases have hit multi-decade highs in recent years. This is not happening by accident. This is a slow, deliberate repositioning. And when the world's largest economies start distancing themselves from the dollar, the demand for dollars as the essential lubricant of global trade starts to weaken. And when dollar demand weakens, the dollar's value comes under serious pressure. And when that pressure becomes visible, when ordinary people start feeling it in their daily lives even more intensely than they already do, the flight to hard assets begins in earnest. This is the part the mainstream media rarely explains properly. Gold and silver don't just go up because people panic. They go up because they are the financial immune system of civilization. Every single time in history that a major currency has been debased or destroyed, physical precious metals have preserved wealth. Every time, without exception. From ancient Rome to Weimar Germany to Zimbabwe to Venezuela, the pattern never changes, only the timeline does. And silver, specifically, has a history of extreme leverage in these moments. In the late 1970s, when inflation spiraled out of control in America and confidence in the dollar reached a low point, silver went from under $2 an ounce to nearly $50 an ounce in just a few years. That's not a 20 or 30% return. That's a move of over 2,000%. And the conditions that produced that move look remarkably, uncomfortably similar to what's building right now. But here's what most people still don't realize about silver's current position. The gold to silver ratio, which tells you how many ounces of silver it takes to buy 1 ounce of gold, has spent most of financial history trading somewhere between 15 to 1 and 30 to 1. That ratio reflected the natural abundance of each metal in the earth. Today, that ratio has been sitting at historically extreme levels, sometimes above 80 to 1, sometimes touching 90 or 100 to 1. What that means in plain language is that silver is cheap relative to gold by historical standards, dramatically cheap. When that ratio reverts, and ratios always revert, silver doesn't just catch up to gold, it overshoots. Because silver is a smaller market, because retail investors flood into it when the story becomes obvious, because industrial demand doesn't stop regardless of what investors are doing. The combination creates a situation where silver can move faster and further than almost any other asset class on Earth. Now consider the psychology of what happens when the mainstream financial media finally picks up on this story. Most people right now are thinking about their stock portfolio, their mortgage, their grocery bills. Silver is not on their radar, but that's exactly the point. The opportunity is always largest when the crowd hasn't arrived yet. Smart money doesn't wait for CNBC to explain it to them. They're already moving. And there's another dimension here that deserves real attention. Physical silver, the actual metal, coins, bars, rounds, is not the same as a silver ETF or a futures contract on a screen. Paper silver can be created in almost unlimited quantities. There are estimates, credible ones, suggesting that for every ounce of physical silver that actually exists in deliverable form, there are many multiples of that in paper claims. When the gap between paper and physical finally closes, and markets do have a way of forcing that reconciliation, the price of real, hold-in-your-hand silver could move in ways that will genuinely shock people who weren't prepared. This is where fear and opportunity live in the same sentence. Because this isn't just a crisis story. For the person who understands what's happening and takes measured, informed action ahead of the crowd, this is one of the most compelling asymmetric opportunities in a generation. Think about it this way. If you're wrong and the dollar stabilizes and industrial demand slows and silver stays flat, you still hold a real physical asset with no counterparty risk. It can't go bankrupt. It can't be hacked. It's been recognized as money for literally 4,000 years. The downside of being early is owning something real. The downside of being late is watching a move that would have changed your financial life pass you by entirely. History is full of people who saw the conditions building and waited just a little too long. The 1970s silver move, the 2008 gold run, the 2020 commodity surge. Every single time there was a moment, a window, where the opportunity was still accessible before it became obvious. We may be inside one of those windows right now. The dollar has done something remarkable. It's lasted over 50 years as a fiat currency without collapsing. That's actually unusual in historical terms, but durability is not the same as permanence. And the pressures building on it today, the debt, the deficits, the geopolitical fragmentation, the de-dollarization conversations happening in capitals around the world, these are not the same pressures the dollar has faced before. The scale is different, the global context is different, and the alternatives are closer to ready than they've ever been. Because what happens next matters more than most people think. If even a fraction of the global money currently sitting in sovereign bonds and currency reserves starts looking for a hard asset anchor, if even a small percentage of that multi-trillion-dollar pool rotates toward silver, the silver market is so small by comparison that the price impact would be extraordinary. You don't need a complete dollar collapse for silver to make one of the most dramatic moves of the modern era. You just need a meaningful shift in sentiment among large institutions and sovereign actors. And that shift, by every measure we can observe, appears to already be underway. So as we come to the end of this, I want you to sit with something for a moment. We've spent over a century building a financial system on the belief that confidence alone can replace substance, that a dollar is worth a dollar, because we all agree it is, that debt doesn't matter as long as growth is happening, that the rules of economic gravity somehow don't apply to the world's reserve currency, and maybe they don't. Maybe this time really is different, but maybe it isn't. And maybe 4,000 years of history, the recurring rise of precious metals every single time paper money experiments have reached their limits, means something. Not as a curiosity, not as a relic, but as a signal. The question isn't whether silver will eventually reflect the monetary and industrial realities that are stacking up behind it. The question is whether you understand what's happening before the rest of the crowd does. I want to hear from you. Where do you think silver goes from here? Are you already holding physical metal, or are you watching from the sidelines? Drop your honest thoughts in the comments below. I read every single one, and the conversations down there are genuinely some of the most interesting on this channel. If this video helped you see the picture more clearly, please share it. Send it to someone you care about who still thinks the financial system is on solid ground. Not to scare them, but because the kindest thing you can do for someone is make sure they're not the last one to understand what's happening. The river is rising, and the people who built on high ground did it long before the rain started.